Maria.
Scott, China's economic recovery continues to gain momentum. Meanwhile, with the government forecasting 8% growth by the end of this year. A lot of this is driven by Beijing's massive $586 billion stimulus package. But how much of the recovery is sustainable, given that exports have not picked up and consumers aren't really spending all that much? Joining me now to talk about that is Steve Nemeth, portfolio manager at Sun America Asset Management. Joseph Meuse is president of Belmont Partners. Gentlemen, nice to have you on the program.
Thank you.
So, Nouriel Roubini made the case recently that China's recovery is not going to lift the rest of the world out of a recovery because it's a GDP of $3 trillion versus the U.S.'s $13 trillion, and it's small. Tell me how important it is to watch China, for starters. Then I want to ask you about the progress in terms of export to consumer recovery. Steve, what do you think?
Well, as a U.S. equity manager, we look at China a lot as the driver for global growth. Even though they're a $3 trillion economy, they do have a big impact on growth. What we were a little concerned about recently is some of the fast food numbers. McDonald's reported, we own the stock. They have a small business, but it's growing dramatically in China. Sales are uncharacteristically cheap. Or sales are a little bit low right now. And the interesting thing is the sales that are declining for them in China are in the industrial areas where there may be layoffs going on due to their export economy. So we're a little bit concerned about that. On the other hand, the government's spending $600 billion, and they got another $1 trillion behind it if they need it to grow the industrial base in the next year. So we're in this teeter-tottering effect where they can probably keep it going, but I don't know about consumer spending there. I think it's weakening.
What do you think? I know you were in China recently, Joe, and do you see this transition taking place?
I absolutely see the transition taking place. Now, I'm going to Tier 1 cities, Beijing, Shanghai, and there is tremendous consumer spending going on there. I personally believe that Shanghai is running at somewhere between 10 and 12% GDP growth. I heard today there are 6,000 infrastructure projects that are there that China certainly has the reserves to continue to stimulate the economy. So I certainly think that it's sustainable. Number two is we are seeing with some of the stocks that we follow, still seeing tremendous growth, 50-80% year-over-year net income earnings growth. So I certainly believe it's sustainable. I think where they're having a problem is just down south, right? The Guangdong province, which is still 100 million people.
Well, what about what Steve is saying? I mean, look, you look at just McDonald's as a gauge. And, if people are not, is it just that they're not spending on food? Or, what are they spending money on that you see?
I see a lot of clothing. I see a lot of clothing retailers doing quite well. I see a lot of car parts suppliers that are doing quite well year over year, which is a consumer product, right? They're buying the automobile. Seeing those do well. I certainly can't speak to McDonald's, but the ones that we follow are doing quite well.
Steve, where is the growth in spending, if anywhere? Do you agree with clothing and autos, for starters?
I'm not sure I agree with clothing. We saw some data out of some sneaker companies, Ling Ning and some other ones, the name escapes me, where their orders going forward were much weaker than expected. They're still positive, but growth is slowing. So you really have to worry about, is the consumer going to spend? Maybe it doesn't even matter. As long as the government's spending money and building infrastructure products, maybe it doesn't matter at all. But I would expect to see GDP growth in China for the next 3 or 4 months. That'll spook investors. I think the Chinese markets probably will come down a little bit in the near term, affecting U.S. markets. But then you're off to the races again next year, because Joe had indicated, and I agree with him, that the government's going to spend a lot of money on infrastructure.
How important is this transition from an export-led economy to a consumer-led economy?
It's critical.
Take it.
I think it's critical for the Chinese economy to be less reliant upon the U.S., Europe, etc. I think they felt the pain, and they're going to learn from it. They're already going through the process of making their economy more efficient. They are closing down factories. They are privatizing state-owned enterprises. They're really focusing on this transition.
Yeah, but I was in China, and the air quality, the water quality is so bad. Right. Are they really making a dent in some of this stuff? I know they talk about it a lot, but do they really recognize these issues as major problems?
We follow a company traded on the NASDAQ, Rhino, R-I-N-O, wastewater treatment business in China, more than doubling year over year. It's a great business to be in. Absolutely, they are.
I would add on that the water problem. We had lunch with the Prime Minister of Thailand today. Their economy seems to be doing better. Industrial utilization's picking up as the export market's going. But if you ask them what they're going to stimulate in their economy for the next couple of years in infrastructure projects, It's water. They want to
Absolutely.
improve their water so they can continue to drive their rice export markets, which primarily goes to China. So water is a key thing. I think a lot of spending is going to go into that kind of infrastructure.
Can American companies get a piece of that? Because a lot of companies, like you're mentioning Rhino, a lot of companies want to do business in China, but they've got to either go side by side by the government or have a small stake in actually the profitability.
Right. I think it's very difficult. I think they're trying really hard in China to deal with only domestic firms. I think
Right.
if you're getting into China this late in the game as a U.S. company, good luck.
Yeah. I understand what you're saying. Okay, so how do I invest with this in the backdrop in terms of China? What are you doing? Why do you watch China so much, and how does it steer your investment, Steve?
Okay, one of the names we talked about last time I was on your show, Transocean, RIG, R-I-G. It's up about 10 points since we talked about it. They're a deep water driller. If China does come back, they're investing in infrastructure. It stimulates the economy. Consumers buy cars. Oil demand's going to go up. They're a big buyer of oil on a rate of change basis. So you want to own certain global commodities. We think oil is one. In addition, we're buying Yahoo here. We've owned Yahoo a couple points lower. We think it has significant upside. They have exposure to China. They have cash on the balance sheet. They own a large portion of Alibaba still. So I think that's another play. And in addition, we have McDonald's, which is more of a U.S.-based company, but it's lagged the U.S. market. We think a little bit of improvement there next year in their China business will drive the stock higher.
Regardless if that transition takes longer than people think, you're still talking about $1.3 billion, and you want to be trying to get a piece of that as businesses, and you want to look for investments that are actually participating.
Exactly. I think Joe invests in a lot of companies that directly invest more. Right? So.
What investors don't realize in America that there are a number of Chinese-listed companies here on the NASDAQ, on the Amex, that don't get exposure. There's almost too much supply of Chinese companies, not a demand for their securities. So we follow Rhino, which I just talked about, doubling year over year in the environmental space, a great space to be in. China XD Plastics, which we own. One car for every 100 people in China, 76 cars for every 100 people in America. Tons of upside potential there. I think that's a great stock to buy as well.
All right, we'll leave it there, gentlemen. Great to have you on the program.
Okay.
Thank you so much. We appreciate
Thank you.
it. Joe, Steve, we'll see you soon.
Great.
Thanks very much. We've got about 20 minutes before the close.